Great. Take it back off speaker.
Perfect. Well, good morning.
Okay.
Yeah, good morning to you both. I'm Ian Campbell with Alpha Capital. Today we're going to go through the online enrollment and the enrollment of the 401k plan. And we're going to go through a handful of attachments. But kind of first and foremost, any questions that you have, please holler out. If you have any questions after you watch this or listen to this, feel free to give us a call as well or shoot us an email. We'll provide our contact information in the email, but also have it on the screen here for you as well. And the online enrollment packet is going to be what we're first going to spend a little bit of time on. It is a 14-page document. The second page is really the most important thing that you'll see today. The Let's Get Started will start at the top of that page. The first step to enroll online is to go to the provider's website, which is Retirement Plan Consultants website or yourplanaccess.net/retirement plan consultants. You will then select online enrollment in the top left corner and follow to enter in the plan password. And the plan password is CE Grace, all capital letters. So make sure you are putting that in all capital letters. It is case sensitive. A good page to reference is pages 8 through 12. It goes into the screen-by-screen, step-by-step example of that process or onboarding step. So you'll see, as we referenced, that top left corner of the gray boxes, you'll see online enrollment. You'll then type in the plan password there and then be prompted to enter in some validation on social security number and date of birth to verify who you are, and then also create username and passwords. After you've done that, you'll go through and put in your personal information to set up your account, pick some elections on how much you want to save, traditional versus Roth, and then also investments. I did want to go and hop into one quick mention. About halfway through the progress, you'll see where it'll ask what source of money do you want for your investment elections. We recommend selecting all sources of money, and what that means is that you're going to pick one investment philosophy and all of your money is going to be invested that way. You can have a variation of different investments, but just basically your money is going to be invested the exact same way. The different money types, so your company contributions, like a company match, plus your contributions are going to be invested the exact same if you select this. If you picked it different, you would then have multiple investment philosophies or multiple investment decisions to make. So we don't recommend that, but we recommend picking all sources of money. For the purposes of the call and the webinar, what we wanted to do is actually hop over to the PDF enrollment booklet to go through what type of information that you're going to be putting in throughout the online process, and also talk about the decisions that you'll be making as well. So you'll see all this is pretty self-explanatory here, just your contact information. One unique piece is going to be your date of hire. So make sure you are putting in that information there as you are completing the enrollment steps. When it goes to the enrollment election, this is where you're going to be making those decisions on pre-tax versus after-tax contributions, how much, and then also with regards to the investment selection. So starting out, hopefully everybody wants to participate in the plan. You're going to have a decision to pick either pre-tax or after-tax Roth contribution, which are those first two options. The difference between the two is when the money is taxed. It's either taxed on the inbound, and you're paying taxes today with an after-tax contribution, or you're going to pay taxes as you withdraw the money in retirement, which would be a pre-tax contribution, and then you're going to pay taxes as you withdraw that money in retirement. Depending on what your tax bracket is right now, what you foresee your income to be in retirement, one may argue it may make more sense to do Roth or pre-tax now, or the opposite, and do potentially Roth later on, or just do all pre-tax. What we generally see is that people who are younger or in a lower tax bracket right now will do the Roth contribution. If you're in a higher tax bracket or higher income earners, will tend to do a pre-tax deduction. So the older you get, the more money you make, the more you would do pre-tax. The younger you are, the less money you make, most people would do Roth. And then I wanted to pause there to see if there's any questions that you had about the difference between Roth and pre-tax at all.
No, I don't think so.
All right, so hopping over to the how much piece, the reason why there's two boxes there, 8% is the national average, 10% is a recommended number that financial professionals would highly encourage individuals save at or save at that rate of 10%. So use those as kind of watermark lines or goals to get to. You do have the option of picking whatever else you would like, so it is completely up to you. Whatever you decide today versus on the pre-tax or Roth or even the how much or even investments, those can change at any time. You'll have website access 24/7, 365, and you can go through all of that information at any time on the website. So hopping over to really the how much question, it is also tied to what's called a company match or a safe harbor match. So there's a company benefit available to you if you save in the 401k. And what that company match is a maximum of a 4% match. And you would have to save 5% or more to get the full 4%. And I'm going to explain it a couple different ways so it's clear. The company match is 100% on the first 3% that you put in, and then 50% on the next 2% that you put in. So if you put in one, you'll get one. If you put in one, you'll get 1, 2 for 2, 3 for 3. If you put in 4, you'll get 3.5. If you put in 5, you'll get the full 4. So it behoove everybody to at least put in 5 to get the full 4. If you do put in something greater than 5, you'll still get that full 4, but it's not going to go above that 4. So if you put in, say, 10%, 10 plus the company 4 for a total of 14. The company contribution, the company match, is always going to go into a pre-tax bucket because the company is not paying taxes on your behalf. So if you're trying to hedge, one versus the other, just understand that company contribution is going to go into a pre-tax bucket. It will not go into a Roth bucket if you are saving in Roth. So there'll be two different money types inside of your 401k plan, one of your contributions and then one of the company's. It's all within the same account. It's just they want to reconcile it. The IRS needs to know, which money is yours, which money is the company's. It is technically all your money, but just the source of the money is what they're trying to articulate. So, does that make sense?
Yeah.
Okay, perfect. So we're going to hop over one final mention. If there are individuals that do not want to participate in the 401k plan, you will need to fill out this paper version. It would be served as a waiver. So you would fill out that top section and select this third option where it says, I elect not to contribute in the retirement plan at this time. It is not a no forever, so you can enroll in the plan on the entry dates, which are semi-annual. So it's January 1st and July 1st of every year. So if somebody does say no, they could start the next open enrollment window or the next open enrollment period. A waiver would be on file for you, and it doesn't, again, impede you on starting it at another open enrollment window. So hopping down to the investment piece, there's roughly about 30 or so investment choices to pick and choose from. Part of Mark and I's role as the advisors on the 401k plan is to review these investments every single quarter to make sure they're top quartile performers, they're low cost, and they're in their top area from a performance score and evaluation criteria for their funds relative to their peer groups and their categories. So all of these funds are what's called institutional grade, which means that they're the lowest cost funds available to investors. So they're all very low cost. They're great performing funds, and there's a wide range of diverse options to pick and choose from. But telling you all of that doesn't really help with the selection. So what we do as an ongoing advice piece is put together this Excel spreadsheet, basically, that provides some education and advice around what we would pick if we were you, and breaking it out into two different scenarios. So the top larger rectangle is for those who want to be a little bit more hands-on with their investment choices. All of the investments are listed on that left-hand column. Their category that they represent is in the second one. The ticker symbol is in that third one. So if you care to do more research, I recommend pulling Google up and just putting this 5 letters into Morningstar or Google Finance if you wanted to get some additional research. You do have access online on the website to look at fact sheets and prospectuses on those investments, but in most cases, they're a few months old because of the last quarter end data. So for instance, the last data available would be around September 30th, which is almost 3 months old at this point. So going to Google Finance or Morningstar would help provide a little bit more clarity around real-time information. When it comes to these top 5 columns, we've broken it out on risk tolerances from conservative all the way to aggressive and in between. So the up rectangle, or the top rectangle, would be for those who want to be hands-on, and we've put together a diversified lineup given that risk tolerance. So if we were you and you wanted to be hands-on, this is how we would allocate our investment elections depending on that risk tolerance. It's appropriate for individuals that would be in their 20s and 30s to be in that aggressive column or the far right one, in their 40s and 50s, that moderate aggressive column, and then in their 60s for that moderate 50-50 column. If you're in retirement or nearing retirement or looking for just preservation in the assets that you have in the account, then conservative and moderate conservative would be appropriate as well. We do update these columns roughly once a quarter. Sometimes we don't have any changes quarter over quarter, and it may be 6 months before we may adjust some of these percentages around or go in one fund or not be in the other. They're all good funds. We just overweight and underweight certain categories given the market news and the overall economy. So the top rectangle, again, is for those who want to be hands-on. The ask is if you're going to follow it, just pay attention to the updates that come out periodically from quarter to quarter. Those will get sent to Dan and then passed on to the employees. The bottom left corner is going to be the target date funds, which would be more of a hands-off approach or more of a passive investment. So you're going to be more autopilot with your investment selection. And the way these work is you would find out what year it will be when you reach age 65 or 70, whenever your ideal retirement age is, and that's going to put you into one of these target date ranges. So let's say your date is 2042. So this one fund would be appropriate for you as 100% choice. So you would put 100% into that one fund, and it is all diversified, all within that one fund. So to give you a little bit more color, the blue ones that I've highlighted, so the 2045 to 2060, they're going to be for those individuals who are younger in nature, or they're going to be retiring in that year or years. They're going to be more aggressive. So they're going to be 80 to 90% in equities, similar to that aggressive or moderate aggressive column. And then you have the next kind of 3 to 4 are going to be closer to that moderate aggressive column, as people are in their 40s and 50s. And then individuals who are nearing retirement or in their 60s are going to be in these, closer to the present year numbers. And they're going to be roughly 50-50. So they start out in that aggressive column. They de-risk automatically every 5 years, ultimately reaching about a balanced portfolio or moderate portfolio. It is a hands-off selection. You're going to pick your investments, and that's going to be your choice. Again, as mentioned before, you can change your investments at any time. There's no cost of going in, out of any of these funds. We've talked about 2 scenarios, one that's hands-on, one that's more hands-off, and the third is you're free to do whatever else you would like and pick whatever percentages you would like in those investments. Our contact information is also on the bottom of this sheet, so feel free to reach out to us with that information. We've got both of our office lines and our emails there as well. So wanted to pause is before we hop back over to the enrollment form and talk about 2 final things. Was there any questions about the investments at all?
No.
Okay. So we're going to hop over to the last 2 pieces. Again, if you're signing this as a waiver, we do need to just sign the last page of this. There's 2 other quick things. As you're going through the online enrollment process, you will be able to elect a beneficiary. Again, beneficiaries are very important. In the event that you pass away, the monies that you've accumulated in this account or rolled into the account go to whom you wish. So please make sure that's up to date. It's very important to have that on file, and it makes everybody's life a lot easier if there is beneficiary information in the system. You can adjust beneficiaries at any time as well. And hop
You
into
can
the
have two
last,
of those.
go ahead.
I'm sorry, you could have 2 of those?
You can have multiple beneficiaries. So if you've got, a
Okay.
spouse and you've got 3 kids, you normally would list your spouse as primary beneficiary, and then your kids you would just list as contingent beneficiaries, and you could break up the percentage and do, 33, 33, and 34, however you'd like to do it.
Got it. Okay.
And then the last mention is if you've got an old IRA, old 401k account, old retirement account out there that you'd like to consolidate with the 401k plan, if you're eligible to participate in the plan, you are eligible to roll that money over. And also in turn, if you're no longer working for the company, you can roll those monies out that you've moved in or you've contributed to out to an IRA or another 401k plan. So this form would serve as the inbound and outbound. There's a whole team at Retirement Plan Consultants that can help do some of the heavy lifting on rolling over those monies and talk to you about that process. There is no cost from a tax standpoint or a penalty of changing providers or rolling money in or out. There's normally a small processing fee from the company that's cutting the check. So if you're leaving, say, Fidelity, John Hancock, Empower, just to name some, they may charge you $25 to $50 to send a check to you, and then you would send that check to RPC, and vice versa. If you were leaving RPC, they charge you roughly $25 to $50 to then process that distribution and check, so you can roll it out to your other accounts if you would like. There is a gal by the name of Stephanie Wolf at RPC that is a dedicated representative that can help and assist anybody that has any rollovers in the 401k account.
Okay.
So with that, it kind of concludes all the information we wanted to review with you today. Again, these 3 attachments will be passed on to you here shortly. If you have any questions, don't hesitate to reach out to us. We're here to assist you, provide advice. If you would like to talk about anything around the your concerns, enrolling online, or have any other questions, don't hesitate to reach out to us. Both Mark and I are available to each one of you individually. So with that being said, we'll conclude our meeting. If you have